welcome Carol Roth, author of The War on Small Business and a second book available everywhere now for pre-order, shipping July. It is entitled You Will Own Nothing, Your War with the New Financial World Order and How to Fight Back. Thank you so much for being here, Carol.
It is my pleasure. Thanks for having me.
Okay, so let's just start with this concept, you will own nothing. So in the description of your new book, You Will Own Nothing, you stated that the World Economic Forum's prediction for 2030 was that you will own nothing and be happy. And to be honest, I've only heard this in the context of conspiracy theories. Was this an official statement, and what was the context surrounding it?
So yes, you hear this sort of meme going around of you will own nothing and be happy. And I had the same visceral reaction when I heard it. I was like, there's no way that this group that's comprised of the elites, the business leaders, the political leaders could be advocating for the end of property rights. There must be some mistake. It must have been taken out of context. So I went and did the research, and there was an article from several years back that was on the World Economic Forum's website that had their predictions for 2030. And the number one prediction was you will own nothing and be happy. By the way, this has been scrubbed from their website. It is accessible still via the Wayback Machine of the Internet Archive. And it's one of the things I have linked to in my book. But then a couple of years later, in 2018, they repurposed it into a video. And the video shared their top 8 predictions for 2030. And again, the number one, really, cute smiling guy, you will own nothing and be happy. And then it continued on something to the effect of everything you want, you will rent, and things will be delivered by drone or something like that. And so this is, by the way, you can still find this up on YouTube with the World Economic Forum marking on it. I'm fairly certain you can also still find it on their Twitter channel as well, LinkedIn. So it's one of those things that sounds very conspiratorial, because why would people not want you to have ownership? Ownership is the path to creating wealth. And we know that throughout history, any regimes where people didn't have property rights, they were not only very unfree and did not have any wealth, but they were also not happy. But it is out there in the open. And that's one of the things that got me thinking about, like, what the heck is going on here, and trying to connect all of these various dots from different places.
Why is the elimination of ownership the goal?
So basically, I think that as the global financial order changes, and this is another thing that sounds very conspiratorial, new world order, new financial world order. Joe Biden talked about it in 2021 remarks to the Business Roundtable. It is on the White House website. He said this happens every 3 or 4 generations. There's a new economic order. And this is true. This does happen every 3 or 4 generations. We go back in history. The US has only been the center of the global financial universe for about 80 years. Before that time, it was the British with their pound sterling. Before them, it was the Dutch with their guilder. Go way back in time, obviously, Rome used gold and silver and the like. And so there is this fragility that is happening with the world, and particularly the US's financial standing in the world. And we can certainly go into detail more about that. But the people who are the elite really want to kind of control every resource possible. And they are currently jockeying to be able to do so. And so if they're controlling everything, it leaves you with nothing. And so I think they're trying to sell this idea, maybe so that you don't push back. And then there's also a separate piece of it, that particularly in the digital age that we live in with technology, it's actually part of their business model. Their business model is for your life to be a service and for them to extract fees, that they get the fees and the ownership, and that you own nothing. And you may find that to be very convenient, but we are being trained in a way that, I may have this phone and think that I own the phone, but what do I own? I mean, I own some glass and some chips, but I don't own the operating system. So if they wanted to turn the operating system off and say, we don't like you, Carol, you can't have access to it, I can't use this phone. Or if I went into my email and the email provider says, we saw some of your posts, sorry, not interested. I can't access that. So yes, I mean, I own this, but this doesn't do anything if all of the things that I have licensed inside of it don't work. So we are in every facet of our life really getting to this point of indentured servitude, and it's coming from every direction. So it's not just like one force that we're trying to battle. We're battling it like basically at every point in time and every place. And I think that's why it's so important, is to empower yourself and to understand where all of these different forces are coming at you and what behaviors you need to change, what financial decisions you need to make, how you need to live your life intentionally in order to have the battle plan to fight back. Because the American dream, if you think about it, is ownership. It's owning a home. It's the white picket fence. It's about ownership. And so if we cede that and we own nothing, basically the American dream dies and our freedoms go along with that.
So to make such a dramatic transition, this owning nothing in such a short period of time, by 2030, that's only 7 years off here. It has to an extent be a welcomed change. From your perspective, what is taking place now that will pave the way for really a global population that is ready to relinquish ownership?
All right, so let me ask you, if I had come to you in 2019 and said, Grace, okay, so next year they're going to shut down a third of the global economy. They're just going to say, like, you can't open your business, you can't go to work. Do you think people would go along with that? What would you have said in 2019?
Crazy.
No way. There's no way people are going to do that. And the reality is, like, at least half the global population went along with it. And they didn't just go along begrudgingly. They were advocates for it. They became the useful idiots and the cheerleaders, and they derived social credit and benefit from being on the quote unquote side of right think. So, you say, how does that happen so quickly? We've just lived through the most insane thing that I could ever not have imagined in my lifetime. And you couple that with just the fact that we're in this late stage financial empire and the cycles that happen and the stupid decisions that are making and the shifts that are happening globally. So everything kind of aligns. And then you have the social credit aspect of it, where you have people who derive the benefits by being the enforcers. And then you have the technology to be able to do it at scale. So it's all of those things kind of coming together at the same time that really makes the timing ripe. I would venture to say that, if you go back to Nazi Germany and how quickly that happened and how that shift changed, I would imagine the people looking back on that would have said, I couldn't believe in such a short period of time how that all moved. And I think we take for granted, because we have lived through a period of prosperity and stability, which happens early stage in financial empires, that we just kind of can't put ourselves in the position, because we haven't really experienced it, even though we may have referenced it throughout history. And we know that history may not repeat, but that it rhymes, as Mark Twain says.
Good point. So in essence, in 2020, really through a health crisis, we saw the relinquishment of personal liberties in a way that was unthinkable. And in a sense, a monetary crisis could pave the way for the same relinquishment on a financial level.
Absolutely. And you have people who are, primed to be on the right side of whatever and agree with the government and to see, only what they want to see or what they're told or the talking point. So, if the government comes out with something and says it's for this purpose, we don't have a population that is, widely pushing back. Obviously, we have some of us who are pushing back, but there's a whole group of people that go, oh yeah, no, that makes sense. We should totally do that.
Yeah. All right. I'm going to segue into national debt. So national debt has tripled since 2009. We are at 31 trillion here in 2023. And for some perspective, national debt was at just over 300 billion in 1963. So that means that we're at an accumulation of 99% in just 60 years. Fundamentally, what does that kind of debt spiral mean for a nation? What is it symptomatic of?
Yeah, it really kind of goes with what we're talking about, this late stage financial empire behavior. Basically, debt and power are at odds with each other because it limits your flexibility. It makes you very desperate. And our government is at a point of desperation where they're trying to continue to expand their purview and grab control for themselves, but they have fewer and fewer means to do so. The way that they can expand the government is basically by taxing you as an individual, and there's only so much that they can do there without you getting mad, or they go into debt, but you have to have somebody who's there to buy that debt. And we've gotten into a point where there's so much debt in the system that not only has it become very expensive and unwieldy in and of itself, but the number of people that we have who actually want to finance the growth of the US government in the future is becoming fewer and fewer. And that kind of goes to what's happening in the shift in the global landscape, basically not having as many folks who want to hold dollars. We have not held the dollar particularly stable. So if you think about this in context, as the reserve currency, most of the commodities in the world, including important commodities, food and oil, are priced in dollars. And so other countries have bought dollar denominated assets like the US treasuries so that they would have that in stock, be able to convert those easily and stably into dollars to pay for those things. But when the dollar doesn't buy as much as it used to, it becomes an economic issue. It becomes a national security issue for those countries. They cannot get oil, they cannot get food at the same level as before. So they're kind of sick of playing this game. And if you look at China, I mean, China used to be the largest holder of US treasuries. They peaked around 1.3 trillion. In January of this year, it was down to just a hair under $860 billion. That's a huge amount that not only are they not looking to buy, but they're actually selling into the market. So putting more supply in the market without a lot of demand. So the only entity left then to purchase the debt is basically ourselves, the Federal Reserve and the US government working together to do that. And that's not a good thing, as we've seen when that happened during COVID, when there wasn't anyone to buy the debt for the emergency spending. We bought it. And what did we experience as a result of that? We experienced inflation, because you can't just make up money out of nowhere and not have that have an impact in terms of the debasement of the currency. So, these things are all very connected. And, it's why they are at this sort of weird inflection point in terms of what they're doing as the elite. And unfortunately, instead of stepping back and saying, we need to right the ship, we need to be long-term thinkers, we need to preserve these opportunities, they're just like, we don't care, we're going to get whatever is ours now. And just too bad for everybody else.
You alluded to it, two ways that historically government takes measures to reduce the kind of debt we're talking about, $31 trillion, selling our debt to other countries, or taxation. Before we move on, are there any other ways that historically debt like what we have today in the US has been worked down?
Well, I mean, I don't know that there's a lot of historical precedent for this, but it could be by shrinking the size of the government and reducing services. Obviously, that's not super popular politically. And so the times when that has been tried, people tend to get kind of angry. But there's not a lot of precedence for being on this edge. And then all of a sudden, somebody's saying, oh, well, here's a great new plan, and we're going to shift it and move back. Usually, as particularly for a major financial empire, what happens is that you end up in a war, and then that war begets a new financial world order. I mean, basically, not every war begets a new financial world order, but every new financial world order has been preceded by a war. Mm-hmm. So usually that's kind of the situation. Now, granted, we're in a different time. There's proxy wars, there's technology. It may not look exactly like it was or has in the past, but the idea that there's all of a sudden going to be this group that comes in and gets fiscally responsible is a possible outcome, but just not a lot of precedent for it.
So you mentioned something in that last round of conversation that Some of our inflation may be due to our debt being less popular on the world market. Is that a true observation of kind of how you just explained?
So I would say our debt comes from the fact that we have a government that spends more than it takes in. I mean, that's the simple fact. That's how they get debt. They choose to finance that overspending with debt. I mean, theoretically, they could sell off assets and pay for the debt, but nobody wants to sell the national park to a private equity firm or something to raise money to pay off the debt. And not to say that it's stopped them. The cheap financing that's has been afforded to the US government by being the global reserve currency has enabled them to take on more debt because it has been so cheap for them to finance. They haven't had to pay a high interest rate for many, many years. So that's really, it's not adding to the debt in a sense directly, but indirectly it does enable the thinking of the government that, hey, maybe we can take on more debt because it's so cheap to finance it, because we're the reserve currency. We have so many people who are coming in and demand for our treasuries and the like. That obviously is shifting, but it's not like the government is adjusting to that. I mean, if you look at the first half of 2023, just reported by the CBO, the deficit for just 6 months was $1.1 trillion. And we're getting to the point where the numbers are so big that I just don't think people can wrap their heads around this. I mean, this is like the GDP of nations. Like Canada's GDP is $2 trillion. So basically we're getting to the point where for the full year, our deficit, our overspending is going to be the same as the output of Canada. Like that's insane to think about. And unfortunately, I just think for the average person who hasn't had the financial education, it's very hard to put that in context and to understand sort of the snowball effect of what ends up happening from that.
And we're talking in terms of the context of existing debt. Now, I'm not sure if this is the right terminology, but we have things that are called, if I'm right, unfunded mandates. Social Security.
Yes. So, in terms of promises, so the debt is basically stuff that we've already bought that we haven't paid for. So think of it as a balance on your credit card. You went out and bought something, you haven't paid for it yet. This is the balance. Our credit card balance for stuff we've already bought is $31+ trillion. This does not include any future promises, whether those promises be from Social Security, Medicare, other unfunded liabilities. In the research for You Will Own Nothing, I think that it was estimated those unfunded liabilities are another $129.1 trillion. And then obviously that doesn't include all of the state level pension messes and obligations that, kind of happen. This is just at the federal government level. So we have layers of insanity here. And so the only thing that they're going to be able to do to pay for the headline is to print more money and to continue to debase the dollar and decrease your purchasing power, because they can meet any obligation just by printing more and covering it, but you're not getting the same value for it, because you have to remember your dollars are a proxy for productivity. They're not just like a random thing. They stand for something. And so when you haven't changed that something, you haven't increased productivity, but you put more dollars into the system, that disrupts the equation and makes your purchasing power less.
So I'm going to get into the debt to GDP ratio. It's going to kind of just basically reiterate what we've already talked about, and that our debt is out of control. But Investopedia, the debt to GDP ratio is a metric that helps understand a country's ability to pay back its debts. In 1963, the U.S. had a debt to GDP ratio of 48%, and according to stlouisfed.org, here in 2023, the U.S. has a debt to GDP ratio of 120%. How far beyond a safe threshold is 120%?
So I'll clarify that I'm pretty sure that 120% is just the public portion of the debt. It doesn't include debt that we owe ourselves, intergovernmental debt, which is another layer because they figure they can just cancel that out. So that's the public facing piece of the debt. If you think about it, it makes sense because you have $31 trillion in debt and a GDP of 21 million or whatever it is. So it's actually on an all-in basis, it's higher, but this is the public facing debt. So there was a piece that was done, I want to say it was by the World Bank, but I might be wrong on that. And they said that the sort of tipping point to where it becomes unwieldy was somewhere between 70 and 80%, I believe. So like that's kind of, even the people who are out there who are connected, who have incentives to be conservative on that, they're going to put out a number that's higher than it probably is to benefit the people that, that they're serving their masters. We're way past that. And unfortunately, again, we're not on a trajectory to shift that. And it's really crazy because if you go back to the level that we were spending before COVID, 2018 and 2019, and you had the same revenues that we had now, you could be running a surplus and you could actually be paying down debt. So the idea that we couldn't be making these shifts and that we're so far away, it's just not the case. It's just the fact that these crazy people in Congress, and oh, by the way, it's both parties. This has happened under both parties. Neither party has been fiscally responsible, but the current administration is just completely out of their minds. There is no quote unquote emergency. I don't think there was one before, but there's definitely not one now. And they're still expanding at a level that is it's just basically a runaway fiscal freight train. And they're just going to keep pushing until the train derails and goes off the tracks.
So you referenced intergovernmental debt. So break that down. What does that consist of that forward-facing debt does not?
So it's basically debt and promises that the government has made to other departments. And it's, basically taking a dollar from this pocket and putting it over here. The reality is there's some obligation underneath that. So I don't know why they don't fully count it. But again, it's not an obligation to someone else. I guess the thinking is that if you were to quote unquote default to yourself, it's not really an issue. Whereas if you are defaulting to a third party, the consequences are very different. You can work it out within the realms of the family, but when it goes outside of the family, it's a different situation, if that makes sense.
Mm-hmm. Yeah, that makes a lot of sense. All right, going to segue into federal interest rates. Let's give a simple definition of what they are. What are federal interest rates? How do they impact the life of an average Joe?
So people hear the Fed funds rate. And so basically, I think that's the rate that you're talking about. And this is a rate set by the Federal Reserve that is meant to be a proxy for the rate that banks lend to each other. Now, there have been some wonky things that I won't get into where it doesn't necessarily exactly stand for that, but that's kind of the proxy. And if you think about what they're trying to do in monetary policy when they influence the rates that banks can charge each other, they're trying to either expand or contract the economy, which just like, let's have a little interjection here. The idea that some group should be able to control when you contract or expand the economy is insane. And the power to do that is insane. But that is the power that they have been granted via their authority from Congress. So basically, if they are trying to expand the economy, they're going to have lower interest rates. That means people can borrow very cheaply. They can go out and they can buy things. They're not going to earn a lot on their savings. So why do that? We'll just go out and spend. So that's considered expansionary policy. When they want to tighten, they raise the interest rates, which is what we're seeing now. And the idea is that capital is more expensive. And so not only are lending standards more difficult, but people and companies don't want to take on as much debt because it's more expensive to do so. You can actually put your money in the bank and earn some return. So that is something that's considered tightening for the economy. And so that's the idea that the Fed fund rate basically flows through the economy, and it has an impact directly and indirectly on other rates, things like what banks charge for mortgages and for loans, and indirectly for, other rates that you may end up seeing out there. It does not directly impact the ability that for the federal government to borrow at, but it indirectly does, because the market tries to align and anticipate what's going on in terms of the economy, and then the demand for treasuries kind of falls out from there. What they did over the last 15 years is they artificially suppressed that rate. They basically held it down so that they could expand the economy coming out of the Great Recession financial crisis. And the idea was that they were going to do that for a short period of time. They also did something called quantitative easing. It's similar to the MMT that we're talking about, where they created dollars from nowhere and went out and made purchases in the market, again, to try to expand the amount of money that was in the market system and to expand the economy. And all of this was done with the idea that this was an emergency or temporary measure. But for 15 years, they did not normalize the interest rates. They brought it up a little bit. The market freaked out. They took a pause. For 9 out of 15 years, the funds rate was at or near zero. So basically they were saying, there's no risk in terms of these banks lending to each other. The capital has no risk. There's no value. It enables lots of debt everywhere. It enables risky behavior and really bad behavior. And unfortunately, all of the things that we're seeing today come out of this 15 years of non-normal policy and the Fed and central planners trying to basically play God with the economy.
So essentially, high federal interest rates make money harder to get. Low federal interest rates or federal fund rates make easy money. And that's basically what the economy needs and relies on to cycle upward as we've seen it.
That's what they will argue. I mean, I would argue that the market demand should dictate, whether or not there's demand for loans or not. But no, they want to direct that from a policy standpoint. So they're putting their thumb on the scale to try to tilt it in that direction. And what we're seeing coming out of it is that we've never had a benchmark where it's been suppressed for so long and there's been so much intervention for so long. So everything is taking longer to cycle through than they expect, which is why you would say, hey, they're tightening, why aren't we seeing the results that we expected, quickly? And it's because everybody has debt already. It's not like it had a huge impact day one because somebody didn't need to go out and borrow, whether they were a business or consumer, because they had 15 years to lock in the debt that they needed. So all of the kind of issues you're seeing, from the banking crisis to what's happening in the economy, these are all basically the outcomes of this undoing of this very difficult period that we've come through, where you've had the central planners putting their thumb on the scale.
So on a little bit more of a precise level, what did the Federal Reserve do to interest rates during the Great Recession, for those who have absolutely no clue?
And they basically took them to zero. It was a slow descent. I think it was like 5.25% before the Great Recession financial crisis. In a very short period of time, they put their target rate, they call it at or near zero. It's 0 to 25 basis points is kind of their target rate. So they did that, and then they went in and they did that purchasing of securities with money from nowhere to try to create an expansionary environment and try to kickstart the economy. And one of the things with their purchases of security, again, you may hear it called QE, is that normally the Fed on its balance sheet has about $1 trillion worth of securities that they use to have enough liquidity in the market, a little bit less than that. And so the intention was they put on, a few $1 trillion that they were going to get back to that, $1 trillion level. They never did. They kept adding and adding and adding to the point where at the peak, they were almost at $9 trillion that they had created out of nowhere and put on their balance sheet. And again, creating the dislocation in the markets and in the economy that we're seeing today.
Did they intend to keep them so low for 15 years straight, or were they just unable to reverse as they wanted to?
It's hard to say what intention is, but certainly they have a mandate, and their stated mandate is price stability, which is inflation, to keep inflation under control, though they like to target it at 2%, and to maximize employment. And they didn't feel like they were in that place yet. That was their cover story, like, oh well, we can't do this because we're not at this place yet where we're meeting our mandate, and so we have to follow that law along with that. But I think that their real mandate is to prop up Wall Street and to make it cheap for the government to spend. And so as long as they were not seeing the quote unquote increase in inflation, and I'll get back to that in a second, government could borrow very cheaply. Wall Street assets were inflated in prices because you had more money pouring into a limited number of assets and inflating their prices. So why would they increase it if they felt like there wasn't the pressure from quote unquote inflation? The challenge is the way that the economists have divided this up is that asset inflation is called asset appreciation, and your spending inflation, your purchasing inflation is called inflation. So who got to benefit from there was inflation, there was a ton of inflation, but it was in housing, it was in the stock market, it was in assets where all of the big fat cats continued to get wealthier and wealthier, and it created a huger divide between Main Street and Wall Street. And so we saw inflation from this right away, but they just characterize it differently. That's the economist's trick. That's the trick of the language. And so, until it was spilling over and, affecting you on a way that you could see it, it was still affecting you. It was making it harder for you to get a house. It was making it harder for you to get a return on your savings if you were a retiree or, a senior citizen living on a fixed income. It was impacting you. But since you don't know these kinds of things, you just are like, hey, it's harder for me to get ahead, but I can't quite figure out why. This is why. It's because all of that interference in the market is inflating all of the assets at your expense and driving non-merit-based inequality. I have no problem with inequality if it comes from a point of merit. If I outcompete you and I work twice as many hours as you do, whatnot, I should get more. If you work twice as many, you should get more. That's fine. When the federal government and the Federal Reserve come in and say, here's the policy, and we're going to keep interest rates artificially low so that you guys can benefit, and too bad for you guys, I have a huge problem with that, and everybody else should too. And by the way, for your audience, because I know you guys are a bit younger than I am, this is why when you look at millennials, by the way, that on an inflation adjusted basis, millennials actually make more money, inflation adjusted, than Gen X or boomers did at the same age. But this is why you don't have wealth. This is why you don't have the houses and you haven't accumulated other assets. It's because of what the government and Federal Reserve have done to you. And you need to understand this in order to help everybody else who understands this stop this from happening and make sure that you don't own nothing, because this is part of their plan.
So we're talking a decade and a half of abnormally low interest rates, never before seen. How did this really mold the financial behavior of the American consumer?
I mean, it's an insane scenario that we're in. We're in a place right now where you have, I think, a personal recession that is upon us, where the average American has taken on just insane amounts of debt. We're at record debt levels. And so they're sacrificing their personal wealth to keep the economy chugging along. And the people who have been the asset holders, the wealthy and well-connected, have been rewarded and continue to gain more money. And you keep getting this, this huge chasm when you see that the top 1% owns more and more. Again, it's not because of just a merit situation, it's because of policy.
So in 2022, it was March, they began to raise the federal fund rate.
Correct.
We're at 4.5% right now. Was that hike from 0 to 4.5% extreme, or did it just have to be done?
So first of all, it was extreme in how far it came in such a short period of time. If you look at other points in time when they've had to raise interest rates, it wasn't a trajectory that looked like this. It was a little bit more like this, different, maybe a longer term time horizon to get that much of a thing, not, boom, we're going straight up. The issue is that a lot of the problems that we're having, there are other things that happened too on the government policy side. You had the Biden administration come in and declare day one that there's going to be a war on fossil fuels. So, from an energy standpoint, we are undersupplied in energy. He put out more stimulus and created more incentives for people to not go back into the workforce. So we have an undersupply in labor. Widely, even before Biden administration, there are lots of barriers in housing. So there are all of these things from a policy standpoint that also created the situation.
Is inflation being curbed to the extent that they hoped for, or was it about inflation at all?
So, to kind of continue on what I was saying before, the Fed, they just don't really have the right tools. Their policy normally would take a while to cycle through an economy. And because we've had this abnormal policy where people have had debt for so long, we've had cost of living adjustments, we've had stimulus, it's going to be a little bit longer until that all cycles through. So I think that they needed to raise it and normalize it. Do they need to do it as much as they did? Probably not. Should they pause and kind of see what's happening? Yeah, they probably should do that. Should they point the finger back at the federal government and say, curb your spending, get the supply constraints out of the way? Like, we need you to be pulling in the same direction here. They absolutely should do that. But there's also a cycle of thought that the Fed may know that we're at the end of this, financial empire, and they could be doing things to create a scenario where they could bring in a digital dollar, a CBDC, central bank digital currencies that some of you have heard about, or have other sort of nefarious reasons for why they're doing what they're doing. Because as going back to where we started the conversation, and the fact that this impacts the rest of the world and it creates issues for other countries and not just our own, it seems to me pretty hard to believe that they don't understand all of those issues and how everything is interconnected. If I understand this, I'm pretty sure somebody who's working at the Fed does. So there has to be some other reason. And it's certainly at this point not curbing the government spending. It's not like they raised interest rates and on all of a sudden the government went, oh, it's so expensive now, we really need to pull back the spending. So there's definitely, just from a logic standpoint, like there's a disconnect somewhere that says to me there's something else here. I can't tell you what it is. I haven't been in the room. I haven't had those conversations, but there are plenty of theories out there of what that could be.
So 1 year almost to the date of the first interest rate hikes, we saw the collapse of two major banks in the USA. Were they connected? Why did Silicon Valley collapse, and was it connected to those hikes?
Okay, so as we talked about, during this period, particularly over the last few years, where they took the interest rates down and they went out and they made huge asset purchases and they put all this money in the system, there wasn't a market demand, right? We said this wasn't driven by supply and demand. It was a monetary decision. There was so much money available that when people went to Silicon Valley Bank and said, here, take my deposit, normally a bank would turn around and loan that out. That's how they make money, right? There was nobody to loan it to. So that influx of cash that we have money and we have nothing to do with it is driven by the Fed. Now, the second piece, which, there's big culpability for the management too, which, by the way, the head of Silicon Valley Bank sat on the board of the San Francisco Fed. So the fact that he wouldn't see this or know what's going on also brings lots of questions to bear, but just bear with me here. So when they said, okay, we're going to take this money, we need to do something with it. It's our customer deposits. We have to do something safe. We're going to put it into US Treasury securities. okay, that seems safe. But instead of just getting like a 6-month security, they decided, oh, well, we can make a little bit more money, because remember, interest rates at that point are being held very, very low. Nobody's making anything on their money. We're going to try and get a little bit more, and we're going to lock that up for 10 years. Here's the problem with that thought. If you hold that for 10 years, it's fine. You get all of your money back. You make that little bit of interest. But let's say there's a reason that things change. Maybe their interest rates start going up because the Fed raises them, which you should have known. And you have people who either maybe they're not doing as well in their business, and so they have fewer deposits, they're taking money out, or any sort of other scenario. Maybe they get more interest at another financial instrument, like, oh, my bank at Silicon Valley Banks only pay this much interest, I could put in a treasury and get 5%. All of those reasons had a lot of companies coming in and pulling their deposits out. And it happened at a clip that was faster than they had anticipated for. But the money that they had backing that, they had locked up for 10 years. Now, at the same time, you have to understand that bonds and interest rates trade to the inverse. So basically, the lower the price of the bond, the higher the price of the interest, and vice versa. So we're in a time of rising interest rates. If I told you the interest rates are going up and I told you they're in the inverse, what's the price of the bond? Lower. It's lower, right? Inverse. So the bonds that they had, that they thought were safe, that if they held to maturity would have been safe, now they have to go out in the market and sell at a lower price. So they're losing money. Mm-hmm. And if more and more customers do this, all of a sudden they're not going to have enough money to cover their liabilities. And what happens in banking, it's about confidence. And particularly in Silicon Valley, everybody's very tight knit. So once people started pulling them and somebody saw their balance sheet and said, oh, they have this all tied up in 10-year treasuries, which are supposed to be safe, but now they have to liquidate them again because the Fed started raising interest rates and now the bonds are worth less. That's sort of what caused the collapse. So the Fed really created issues for this bank on both sides in terms of having too many deposits coming in with nowhere to put it. And then once they put it somewhere, basically changing around the dynamic of, what the treasury might have been valued at any point in time. Now, again, totally boneheaded move by the management, by financial people. So you can't absolve them of that. But by the way, they're not the only bank that did that. If you go to like the major banks' balance sheets, a bunch of them did that too. They just didn't have as much exposure to retail deposits, and they had a more diversified business, so they weren't as impacted by the possibility of a bank run. So that's basically the very clear breakdown of what happened. And you can see the Fed really created the situation on both sides.
So you just mentioned, you said not as many retail deposits. Did Silicon Valley have a significant portion of retail deposits? And does that reflect consumer demand?
Yeah, so they had retail deposits, and then they also had small business deposits, but they didn't have a diversified business. Like they didn't have as much maybe as wealth management or investment banking on a percentage basis as some of these other companies do. And I think that's just a function of what their bank was strong in. They were a strong partner to the venture capital community, and that was really kind of the focus of their business, was doing the cash management and the day-to-day for Silicon Valley. They did have other parts of their business. They had investment banking services, but just not on a percentage basis. They weren't as well diversified as some of the bigger banks, and certainly didn't have the scale either to be able to withstand.
Okay, that makes sense. So some say there is a 12 to 18 month lag before the negative repercussions are felt from an interest rate hike. We saw 1 year to the date of, I think it was just 0.5% increase, that particular collapse happened. From your economic vantage point, are you seeing any precursors to continued fallout in 2023?
So I did a chart, and I put this on Twitter and Instagram that you can find, that basically laid out sort of the trajectory of the Great Recession financial crisis. And if you go back and you look at some of the early collapses and some of the early rescue situations, that was like in the first maybe third of the Great Recession, financial crisis, and before things got really ugly. So I think there are a lot of areas of weakness within the financial system, pretty much in anything that you could talk about, whether it be zombie companies that took on all of this debt and now aren't making enough money to be able to repay the debt, whether it be corporate real estate, people have decided they're not going back to work, whether it's just the overall derivatives market, which has exploded, whether it's the de-dollarization issue. I mean, there's just like so many pockets of places where this could go. If I had to guess of something that could end up being a contagion that I've been sort of talking about in my circles, is that there could be an issue in Europe with their sovereign debt, particularly if energy prices continue to go up and they have a really cold winter next winter, which could then come back and have repercussions in the US. So there's like US contagions, there's global contagions, and just given the scale of what we've been through, the idea that the only carnage was maybe these small things, I would say that there's probably a good chance that that's not the end of the story. But again, it may end up coming out in a completely different way. And it also depends on some of the decisions that are being made now. So it becomes impossible to predict how all of those decisions impact the future.
I'm going to segue into currency collapse. What is currently upholding the value of the US dollar?
Well, the US dollar is basically, they say it's full faith in the US government, but it's really full faith in the American people. As I said before, it's just a proxy for your productivity. So we still have a fantastic nation filled with very productive people, although not quite as productive as they used to be, but lots of innovation and lots of great companies. And that's what people are buying into. They're not buying into the US government. They certainly aren't. It's not being backed by anything else. So, there's a reality about what underlies it, but it still doesn't keep it from being debased, because as I said before, we have productivity, but if they increase the money supply by 3 times, we're not going to be able to triple our productivity nationwide all of a sudden overnight to keep pace with that, if that makes sense.
What is the significance of Saudi Arabia and several other countries moving away from exclusively trading oil in the US dollar?
Ooh, this is new financial world order. This is like center of the plate of what I'm talking about things shifting. As we talked about in the beginning, we've been the global center of the universe for 80 years. And, most of the commodities are priced in dollars worldwide. If there is a long-term and concerted move away from that, that impacts potentially our military security. It impacts the quality of life that we have, the government's ability to borrow cheaply. It possibly, creates the ability to get things. If this ends up, the U.S. doesn't want this to happen. If this becomes a excuse my language, a war here, where then all of a sudden these other countries may cut off access to us or our allies from anything, from whether it be oil and gas to rare minerals that we need and products that are imported from China. I mean, who knows? But the implications are not good ones for the U.S. and any country that has gone through a shift in the financial world order. It's a painful transition, and it's not linear. It's usually takes some time. It's chaotic. It's bumpy. Not to say that, we're going to necessarily end up like Venezuela, but not to say that's not completely off the table either. I just think it's a minor possibility, not the probability, but it's a change in the wealth creation opportunities for the average American, and it shifts the standing in the world and sort of the stability of the global economy.
And that's simply because, if I'm right, the buying power of the dollar decreases.
Correct. Simple as, think about it in terms of financing costs, right? As we said, if you have dollar demand, it brings down those interest rates. You have treasury demand, brings down those interest rates. And so the government can finance things cheaply. You can go out and you can have a strong dollar and you can buy things and import things. Now it hurts our exports because it's more expensive for people when you export. But from an importing standpoint, we have an arbitrage opportunity, and that goes away.
The 15th BRICS Summit will be held this August, and there is rumor that the BRICS nations will introduce the concept of a new currency, an alternate currency that will rival the US dollar. What would such an announcement do to the value of the US dollar?
So first of all, I think it would be helpful to define BRICS. So BRICS is Brazil, Russia. I've now made them one country: Brazil, Russia, India, and China. And we're now calling it BRICS Plus, or at least I am, or some people are calling it BRICS with 2 I's and 2 S's, because Saudi Arabia is being brought into the fold, and possibly Iran as well, if you can imagine. So to the extent that they come out with a new currency, I think it really depends on what it is and if it's different than the rumblings that we've already heard. China's already has sort of a global facing yuan for settlement, which is their currency that is backed to some extent by gold. So if you don't want to hold the yuan, you can exchange that for gold. And that's kind of how they're getting around the issue of nobody wants to hold a communist currency. There are lots of shifts in terms of countries that are saying, okay, I'm going to move away from the US dollar, mostly smaller countries. But it depends, if they come back up with a gold-backed currency, obviously I think that's pro for gold and against the value of the dollar. And it's just a question of, scope and duration. It's certainly not a good development, and how that ultimately plays out and the acceptance, and if that's just, certain blocks that end up using it, or if you have a situation where, because we've given up some of our energy independence and we can't support our allies, and our allies are buying from BRICS nations and they're being forced to go into other currencies. I mean, that could be something that has massive reverberations, and whether that happens right away or that happens in 4 years, I think those are some of the real risks that we all need to be very aware of.
In the 1970s, when we were officially ripped off of the gold standards, it correlated with that petrodollar, the introduction of that requirement. And that has upheld and really backed a lot of the value of the dollar.
Yeah, what used to be good as gold, the dollar was good as gold, is now good as gold for oil. And so basically that became sort of the de facto backing of the dollar. The agreement was that the central banks would generally keep the price of the dollar stable so that there was some stability for oil. And then the Saudis would take the money that they're getting in terms of dollars and plop that back into buying treasuries, which, as we talked about, created the opportunity for the US to have this low cost of financing and an arbitrage opportunity. Again, unwinding that is not good for the strength of the dollar. It's not good for all of those pros and privileges that we've had, and doing it at a time when we and our sort of G7 allies are all moving away from traditional fossil fuels is really creating this chasm in the world. You have the developing world and some of these other countries that want to grow and want to flourish, and they want to use fossil fuels to do it. And then you have our countries, which, oh, by the way, all have really bad demographics from the standpoint of an aging population and lots of debt. And we're now all of a sudden doubling down on green and getting away from that. I think that's going to end up being, when they go back and rewrite the story, a very, very telling thing. And I think that you may see some splits in terms of the world. And it's the growth part of the world versus the potentially decaying part of the world, which is in some ways being pushed by this ridiculous energy policy that we're pushing.
It's a good point, and we could talk about that one, but we're going to close it out here in about 5 or 7 minutes. I'm going to segue into proactive steps here. There are a lot of people who are storing a majority of their wealth in the US dollar. Are they running any risks by not diversifying?
I think that under any circumstances, diversification is very important, because you never know what's going to happen. Now we have sort of a different set of circumstances. Diversification is even more important. And the most important thing that you guys can learn is hard assets that you can actually hold in your hand that have tangible values, whether that be a precious metal, whether that be your house, whether that be productive land. Those kinds of things in terms of stores of values are not dependent on the dollar, and they're not things that, if it gets digitized, are going to be shifted and present a different way for you to hedge and diversify your portfolio. So I am not a financial advisor. This is not financial advice, but everybody should have a financial advisor that they're talking to. And probably a lot of them are not up on these things. So take that as a baseline, and then, perhaps add in some of your own thoughts as well. But yes, you should definitely, if you are a subject of King Dollar, as you said, storing your wealth in dollars, you have to allow for the risk possibility that there is going to be further degradation in the value of the dollar, because you have the history that points to it. They have completely, the large majority of the dollar's value since 1913 has been completely eroded. And even though it buys a lot on the world stage right now, as we know, it's not holding up stable against our bag of groceries. And that change is only going to get exacerbated and worse based on all of the things that we've been talking about here. So it is incumbent upon you to really take control of what you can. This is a lot of heady stuff, a lot of stuff you cannot control, but take control of what you personally can do. And then also, worst case scenario, things like if some stuff goes really bad for some period of time, make sure that you have the right supplies, make sure that you have things that you can barter with, all those kinds of things. I mean, I'm not like a traditional prepper or anything. It's called like prepper light, but be prepared. Think about all the scenarios that could happen and take some steps to be in that direction, because when it does happen, like, it's going to be too late. It's like kind of like buying insurance for your house once it's already on fire. Like, take the steps today. We know the trajectory. We don't know the timing. This could happen in 5 months. This could happen in 15 years, or it could happen in 50 years. Like, I just can't tell you that, but you need to be prepared for all of those time frames. So don't panic, but do prepare.
You were just talking, you mentioned the central bank digital currency.
Yes.
Kind of segues into an opinion piece that I wanted to ask you about. With the impending crash of the USD, will the West introduce a new currency of its own? Is there any way to know what that would look like?
So the idea that there's going to be a central bank digital currency, I think, is going to be sort of an interim step to try to stem some of the issues we're talking about, the too much debt that they have, the shifts in this financial world order, and some of the de-dollarization. So absolutely, they are trying to bring out a central bank digital currency and a digital dollar. We know this because the New York Fed did a pilot program with many major financial companies. The G7 came out with principles for retail facing, which is consumer facing, central bank digital currency. So they are trying to do this. What you need to do is push back and make sure that Congress does not adopt this. I mean, it's like, if you've ever protested, wrote a campaign, like, there's nothing more that when they try and do this, that we have to stop it, because it will be the end of our freedoms. It will be the end of wealth creation opportunities. It will marry social credit with the ultimate tool of control, which is complete control over your money. And by the way, it creates a system that is like beyond too big to fail, because there's only one point of risk. And if a hacker takes down the central bank digital currency system, there's no other option. So it seems like the worst idea in the world, and we must vehemently oppose this.
All right, one more question. Water rights. Harvard just purchased water rights in California, I believe it was. There's rumor that Bill Gates is buying farmland, not for food, but for water. Is there any merit to what we call the elites actually scooping up all of this water
I have
right?
an entire chapter, and you will own nothing about this. Well, actually, it's half of a chapter. It's also about corporations coming in to compete with you for single family housing. But the second part is the land and water rights. And so you are correct. Harvard had an entity called Brodea that was buying up a bunch of land that had water rights attached to it. Bill Gates, has become the number one individual owner of farmland in the United States. So on one hand, it's a good pattern, right? Look at what the wealthy and the elite are doing. They're buying hard productive assets. They're buying land that does things like, farms and ranches and timber and water rights. Also highly, highly concerning in terms of control, particularly on the water side. The idea that water might be financialized is frightening. So this is something, again, to take a peek at and do what you can to prepare. And if you can, take a cue from them and do it yourself.
To end on a practical application note, we've talked about it a little bit already, but what are practical steps that you would take?
So I think it's all the things we're talking about. I think there are behavioral issues. I think there are community issues. And I think there are personal issues. So, from a purely financial standpoint, you want to have that diversified portfolio. You want to be putting some of your money into hard assets where you can, so that you have something that isn't a form factor that you can control, or at least mostly control, have better control over if things go sideways. And I think it's a discipline side. I mean, some of you listening may have lots of debts. So your first step may be getting out of debt first and changing your financial habits. It's going to be very personal for each of you, but I know that each of you can do it. And at the end of the day, the American dream is built on ownership. It's the cornerstone of wealth creation, and it's something that's very important to you. The other thing I would say is keep an eye out for changes in inheritance laws and wealth taxes, because that is going to end up impacting you hugely. There's $84.4 trillion that is going to be passed down in the next 23 years based on estimates. And so that is an opportunity for wealth to be passed down from the boomer generation to younger generations, and you don't want that sucked up. And the other thing you need to do is obviously basically oppose any government expansion, because government expansion, again, is giving more money to the wealthy, the well-connected, and the older generations at the expense of the younger. They have gotten far more than they needed from you, and it's just not fair to keep putting that burden on you. So all of those things are things to think about. And if you're thinking about become active, there's a lot of social activism. There's really not a lot of good financial activism, particularly coming out of the center and the right. And I think it would be great to see more.
All right. This has been a gold mine. Can you give people a way to touch base with you ongoing?
Yeah, so I love the gold mine pun. Physical gold out of your gold mine. So if you want to connect with me, the place I spend the most time is on Twitter at Carol J.S. Roth. But you can also find me at the same handle on Instagram, on YouTube from time to time. I've got a website at carolroth.com. And then most importantly, 718 is the new book, but you want to pre-order it now. Anywhere that you buy books, you will own nothing. And the reason you want to get it is to get empowered and get the knowledge so that you can own as much as possible.
All right, guys, you heard it. I have pre-ordered my copy.
Oh,
thank you so much, Carol, for joining us. I so appreciate it, and stay in touch.
Will do.